Hello, everyone. Today, let's talk about why institutional trading desks prefer mean reversion strategies. So first, I'd like to discuss what is mean reversion. So mean reversion is the idea that prices tend to return to their average or the mean after moving too far away. Mean reversion strategies exploit this, and they bet on reversals back towards equilibrium. Institutions favor them mostly because most of the markets are range bound, 70 to 80% of the time. So it makes mean reversion more reliable and it provides more frequent signals compared to trend following. So what are examples of mean reversion strategies? Some of which make use of Bollinger Band re-entries, like the outside close and then back inside the Bollinger Band and enter. Others use the RSI extremes or the relative strength index. They make use of settings like RSI 2, which is a faster or a more reactive RSI setting, less than 10 level oversold, and over 90 is overbought. So once price reaches those levels, like less than 10, it's oversold. So you can then buy back if the market reaches, or if the RSI reaches more than 90, it's said to be overbought, then you start shorting. You can also take longs on undervalued assets, and you can take shorts on overvalued assets. Basically, moving average reversion. If price is stretched far from the average or from the mean, you can trade it back towards the average price. The time frame used for mean reversion strategies are usually short-term or intraday time frames. So why do institutions favor mean reversion? Well, we have to look at it this way. Markets are range bound 70 to 80% of the time. This means that mean reversion strategies work more often than trend following. You can also expect lower drawdowns compared to trend following, which can suffer, especially during sideways markets. It's also easier to scale with large capital, where institutions can fade extremes without needing massive trends. Another factor is the statistical reliability. It's easier to quantify and backtest mean reversion strategies. Finally, liquidity harvesting. It aligns with institutional behavior of liquidity sweeps. And once liquidity has been swept, then most of the time markets would actually just reverse and go the other way around. Okay. Now, if we compare trend following versus mean reversion, trend following, of course, profits from long sustained moves. It works best in strong trending markets, which are quite rare. And there are long periods of small losses, punctuated by big wins. In mean reversion, profits are frequent because due to snapbacks to average. It works in sideways or range-bound markets, which are more common, like what we mentioned, 70 to 80% of the time. You may have many small wins and fewer large losses. But the key takeaways here is that mean reversion, which is higher frequency, you can have steadier equity curve. Trend following, you have lower frequency, and the takeaway for trend following would be you can have higher payoff days when trends occur. Institutions prefer mean reversion because markets spend more time ranging than trending. If you end up waiting for trends, then you could be waiting for a long time. Mean reversion provides more consistent opportunities as it aligns with liquidity-driven market structure. Bottom line we can take away from this would be mean reversion strategies dominate institutional desks because they exploit the most common market condition, which are ranges. and provide steady, repeatable opportunities, while trend following is powerful but less frequent. So let me show you one of the mean reversion strategies that I use every day in the market. And I'll also show you the rules that I follow, the entry rules, the exit rules, risk management, and what exactly am I looking for. Okay. So let's look at a chart of DAX 40 or Germany 14. The indicator I'm using here would be the Bollinger Bands, and I make use of the 4-hour time frame. It's a step down from the daily. The daily provides really few signals and trading opportunities. 4 hours more like a good balance for me. I'm not in a rush. I'm checking my charts every 4 hours. The most when I am asleep, I am able to check at least 5 candles. Okay, so currently I am located in Asia, so I check charts anywhere from 5 a.m., 9 a.m., 1 p.m., 5 p.m., 9 p.m., and then usually don't catch the 1 a.m. candle. I'm already asleep. So anyway, 4-hour time frame, I make use of the Bollinger Bands. Its default setting for the upper and lower bands, 20, and standard deviation is 2, no offsets. I do change the middle line to another setting. So if you can see, the yellow line here is actually the default 20 EMA that you can find in most of the Bollinger Band settings. I actually changed it to 30 EMA, which is now the white line, simply because the 20 EMA for Bollinger Band is very reactive. So it could, of course, react to price changes very fast, but it leaves some of the profits off the table. So as you can see, I'm able to squeeze a bit more profit if I make use of the 30 EMA, which is, I think, more institutionalized. Um, it depends on you. You may make use of the default 20 EMA midline, or you can do what I do. I use 30 EMA, which is the white thick line right here, in order for me to capture more profits. Okay, so the rules of this strategy is quite simple. What I'm waiting for would be price to close outside of the upper band or the lower band of the Bollinger Bands. So I need a clean close outside of the Bollinger Bands. Now, the next thing that I want to see would be a sweep of a previous daily or previous weekly level. So in this case, we have a sweep of a previous weekly level. Okay, so liquidity is therefore taken from that level. Now, what I need to wait for next would be for price with conviction to close back inside clearly, okay, inside the Bollinger Bands once again. This would tell me that there's a higher probability that price is reversing and would go back to the mean, which is the 30 EMA. So once I see a close outside of BB, a sweep of a previous daily or weekly level, and then a close back inside a BB with conviction. I then enter as the next candle opens. I put the stop loss just beyond the sweep candle low right here. Depends on the direction. In this case, it's sweep candle low. If you're taking a short, it's sweep candle high. Then I'll be targeting the 30 EMA. Okay, note that this is a dynamic target. That means it moves. Every time a new candle is printed, it moves. So you got to treat this as a zone. So what I do is when and as soon as price touches the 30 EMA, I would close 80% of my position. You can do that on MetaTrader or I think you would need an EA, but for me, I just adjust that and take my profits, 80% of the profits on MetaTrader. Okay. As price hits that 30 MA, I already banked 80% of my profits, after which I move my stop loss to break even. Okay, and I let 20%, the remaining 20% of the position to run and take out previous daily highs or previous weekly highs right here. And then I take profits. Okay. Now, mind you that I am waiting for clean closes outside and clean closes back inside with sweeps of previous daily or weekly levels, either or weekly or daily. Then I enter, target the 30 EMA midline, and I take 80% of the profit, 80% position. I close 80% of the position, take that profit. I move my stop loss to break even and let 20% run to the next previous daily high or previous weekly high. Okay, some more examples right here. You can see a price is trading farther away from the 30 EMA midline, a clean close outside. Okay, a sweep of previous daily or weekly level right here. Then price closed back inside the BB with conviction. I enter at the next candle open, stops at the swing low, okay, of that sweep candle, targeting that 30 EMA midline. I take 80% of the position off. Okay, afterwards, I let 20% run towards the next daily or weekly high. Of course, I needed to move my stop loss to break even, making it a risk-free trade. Now, at some point, you may wonder, it might not always happen this way. So this is a grade A setup, but there is also a setup like a grade B setup. Okay, so here's an example of a grade B setup. You have to be careful here with grade B setups. I usually take a smaller position size when I presented with these setups. So you can see right here, price is trading farther away from the 30 EMA mean. And then there are multiple closes outside of the BB and no close back inside yet. Now, what happens here is that the price closed inside, not with a bullish candle, but still bearish. And naturally, it just drifted back inside the Bollinger Bands, right? It's not like the examples whereby you have a close outside and then you have a close back inside, which has more conviction. Here, in this case, price basically just drifted back inside naturally on its own. So you can still take these trades, but I would caution, and you ought to use smaller position sizes. Okay, so still the same rule. Once you see a candle towards the reversal direction, enter the next candle open, sweep candle low, it's where your stop loss goes, target the 30 EMA midline. Once that happens, take 80% of the position off and let 20% run. Move your stop loss to break even. Target the next daily high or weekly high. Okay. In this case, you'll see that it has been reached. Okay. So this is grade A and grade B setup for you. I would, of course, most of the time be looking for grade A setups. It keeps my equity curve smoother. It has higher probability compared to these kinds of setup that just naturally drifts. But of course, you have to understand that this price action has gone too far away from its mean already. So um, the higher probability, the higher, or sorry, the more distance it travels far away from the median, then the higher probability it would go back. Okay, but it's not always the case, especially in trending markets. So if market is trending, it may close outside, like in this case, there's a close outside and a close outside. but it doesn't really go back to its mean right here right away. And this is why the close outside and the immediate close back inside is very important. Okay. Um, Similar to this case right here. Okay. So there's a close back inside right here. Okay. Close outside, outside, then close back inside. Okay. Unlike this one, the grade B setup, close outside, then a natural drift inside. This one is a grade A setup, close outside, then a candle that closes back inside with conviction. Okay. So those are the differences. There are many other mean reversion strategies, but this one is actually one of my favorites. It provides me with more frequent signals, making use of the 4-hour time frame. So I hope this video has helped you understand what mean reversion is all about, and perhaps you can make mean reversion strategies part of your arsenal, or what you call trading arsenal, or your battle playbook. Okay. Um, until next time, thank you. This is Johnny De Leon. Hoping that you trade safely and that you have a good trading journey.